thing. Let's invite N. Jayakumar, President of Prime Securities, who joins us right here in our studios. Jakes, good morning.
Morning.
Good to have you. My mind goes back to the post-demonetization news, and when we had you in studios, you said it won't surprise you if the market hits new high in January. It's taken maybe a bit longer, but in February we are at new highs, 52.
Well, I'm sure we'll take that, but one of those lucky predictions, I guess. But
No, it's more than that. But what made you sense that the market's in a mood to absorb bad news?
Yeah, I think more than the prediction itself. I think the thought was that if you looked around there, that you were in a minority, and at most times like this, I think it makes sense not to use your own intelligence, however limited that might be, which is actually to figure out what the public was saying. So, if you see that the fact that something like a demonetization was even attempted was big news, and people were expecting the worst. Apocalypse was actually the kind of prediction at that time, and then Trump was even more outlandish a prediction. Absolutely. Which came true. So in that scenario, it was logical that people went into their sort of terror shell, if you will, and people were extremely scared. There was a lot of fear in the streets, etc. So the thought was that give it a 3-4 month period. And some of this could actually turn out to be, stuff that the markets, and we've been seeing strength in the markets, make no mistake. I think the markets were telling you right through that. And the fact that Brexit came and went, the fact that so many events came and went when the markets least expected them. It's usually said that, crowds don't make money. So when everybody was on one side, it was very inconceivable that they would actually end up being all being right, as it were.
Has it now turned the other way around?
If the crowd is exuberant?
You could say that, but there's one particular metric I'd like to point out, which is this: the biggest activity in the market is in the futures segment. If you see the futures month-on-month carry-forward rates, they are still at about 0.4 to 0.5% a month, which indicates an annualized rate of 5 to 6%. Now, no money lender puts out money at 5 and 6%. So it's usually, if futures positions are being carried forward, I kind of hasten to add that there's a lot of shorts getting matched with the longs, as it were. So which means that you're talking about, of course, there's been SIP money and arbitrage money coming, but it surprises me that they've settled for 4 and 5% returns, which is the annualized return net of all the costs that are coming through. Now, typically, the froth is indicated in that space. So I think a lot of foreigners or foreign funds, hedge funds, are short in the futures, and therefore the market has adequate cushion. That's why it doesn't keep, it doesn't fall perceptibly beyond a point. And when I say beyond a point, is a 3, 4, 5% fall immediately meets with buying. And this is indicated by the fact that the futures premium are at very, very low levels. And that, to my mind, is the biggest underpinning of this market. The second thing is
not frothy.
And it's not frothy. The second thing is, if you ask me, optically things have moved, but have people been in the stocks where they moved? I mean, Reliance has moved 10%. How many funds have sort of table thumped and said, Reliance has been in an overweight position and we've got it right? They haven't. The second thing is, if you take local markets, and I don't want to mention names, but some of the biggest names in the markets, in the domestic market, who would be 365 days having futures positions, if you will, have actually been completely absent in the 8,000 to 9,000 run, or very, very limited in their participation.
Oh.
Given that kind of thing, I get the feeling that this big great Indian public buying which has happened, which is the SIP money, the 10,000, the 15,000, which doesn't get noticed or earmarked as this is buying, as it were. But the sellers. So in this market, who the sellers are. Foreigners are selling. That private equity funds are selling. The government of India is selling. That issues are coming through. Who's the buyer? You don't know the buyer. When you don't know who the buyer is, and it's the great Indian public, in a manner of speaking, which is quietly lapping up without ostensibly creating a noise, as it were, I get the feeling that we're in the midst of a very powerful rally. And when you look back and you see that now, suddenly in the last 5-7 trading sessions, you've had 5 big things that have happened. The buyback in the IT space led by TCS, the huge Reliance move, the subsequent upgrades, Morgan Stanley going gangbusters, etc. on Reliance. The fact that the Trump announcements haven't been followed with policy measures, as it were, which means that pharma and IT may have actually more than skipped a bullet. And you suddenly take into account the Bharti, the telecom, the coming together of Vodafone, etc. So these events, of course, the telecom thing was a little, dated. But each of these events tells me that the market has got suddenly one finite leg to stand on in addition to what it already had. Okay. So which means when I look back and say, I can see 8,500 as a bottom for the moment.
Okay.
And that...
Okay, let me play devil's advocate in that
Sure.
case. Would valuations be a worry? After all, we've not seen extraordinary valuations. I think the third quarter still managed about 8% in terms of earnings growth,
Sure.
which is much better than any of the previous quarters we've had. But that was still below what the street was expecting for several stocks. So is valuations a problem?
I mean, will it surprise you if at 9,200, foreigners suddenly turn buyers here? And will they then use valuation as a logic to say we shouldn't be entering the market? I think the feeling of left out doesn't need to be in individuals alone. It can be anywhere else. Foreigners have been broadly on the sidelines or negative,
Yes.
especially if you take the private equity flows as well. So to my mind, this is not a market about valuations. This is a market on fund flows. The fund flows are just too strong. And for the moment, you can argue that 16 multiple is expensive, so 18 is even more expensive. I can argue that if 18 is expensive, maybe 20, is a little, tad more expensive, or maybe not. The point I'm trying to make is this is not a valuation-driven market for the moment. It's a market where participation and the fact that you don't have too many other avenues to invest in is making money come in, which is creating a wall of money, and valuations inevitably will rise, maybe get justified. Now, all that happened in Reliance at the end of the day was that they announced a scheme which said that they would go into the pricing mode, which was broadly expected. You could even argue that they were 3 months later than what was originally envisaged. And that has prompted a re-rating from a 900,000 level to potentially 1,500 to 1,900 level. What's happened? What has changed? Has valuation suddenly changed? Second, in the pharma space, I think the greatest amount of emphasis on compliance is going on. And I personally believe that that kind of thing can only result in a solid base being formed at current levels for companies that are cash flow producing. The IT space is rich in cash, not cash flow necessarily, cash flow followed by cash as well, which means they do enough to sort of, tweak their business models or whatever. Given all this, I somehow get the feeling the market will surprise us with announcements, with, individual sort of stock measures, which will actually, you look back and say, we kind of missed a huge bottom in the markets.
Okay. Lots of pieces are falling together for the market, Jake. So one that's not is Tata Motors. How do you approach that now? And how have you looked at the correction? One bad number, and the big margin disappointment, of course, from JLR. Do you think the street is right in the kind of fear that it has right now?
I wasn't actually budgeting to talk on specific stocks, but with the disclosure that I, on a personal portfolio, do hold Tata Motors. The way I see it is, I don't think this particular result has done anything other than highlight or bring about the unexpectedness of operating in multiple countries. The fact that the sterling pound has been sort of weakening the way it has, and the ramifications on multiple currencies and selling into multiple markets, I think is coming out, because I've never had a conference call which was so focused on hedge losses and hedging strategies. You almost wonder whether there should have been an FX. It is an FX company rather than selling cars, etc. The business plan hasn't really changed. I mean, they are in multiple spaces. I think they got a few problems in the local end which they'll probably work out. So I don't think the business is affected. The fact that they hedge the way they do and they need to hedge, they operate in so many countries, is a reality. Now, again, to my mind, that hasn't changed. It's brought about the vicissitudes of that operation. Otherwise, I personally think nothing has changed. And if you look at it, most of the brokerages may have respectfully brought down their price targets by 4 or 5%, but nobody has said 800 target going to 400 kind of thing. I mean, most people have come off 5-7%. So I don't personally see the business having changed too much.
Okay. Well, now to the banks. Would you still think that it's only the private sector banks? How do you play this huge giant?
I think the way to play this space is the way private sector banks got re-rated quarter on quarter for several years. I think that turn is now, the baton is now shifted to NBFCs. I think the NBFCs are disintermediating banks, and I think without a shadow of doubt, the nimbleness And the fact of these NBFCs, the multiple niches they operate in, makes them a very, very compelling case. And as governance in many of these improve, as business models get more tweaked, and as collateral, which is especially housing finance, for instance, gets as real as it is, with the thrust on housing being the way the government is articulated, and I think if if elections indicate that UP also will go the BJP way, if that happens, to my mind, this thrust on, there will not be a thrust on populism, but there'll be a thrust on the roti kapda makan being even more solid, which means housing, related shops, etc. I think housing finance, housing finance companies, NBFCs in that space, and maybe with a little caveat saying I'm a little worried on this, on the microfinance space. As I understand, it's unsecured lending, and every time I've lent money to our domestic help, etc., it usually gets adjusted. It never comes back. Now you're telling me there's a bunch of companies who are lending at 25, 27% interest rates, imputed cost, and money comes back quarter on quarter. I mean, to my mind, it's a little difficult to understand. And the fact that some of these companies are being contemplated for merger into private sector banks worries me. So I think, to my mind, the business plan of, in their zeal sort of, or their zest for growth, I don't think private sector banks should plunge, into multiple areas of, where angels fear to tread, if you will. So I think that's the one caveat I would have.
Oh, yes. A conversation with Jakes then. So Jakes, you've spoken about a lot of sectors, which are now doing well and, looking quite good. What about metals? This general miss out feeling has been most pronounced on metals, of course. Do you get a sense that things could, look up even from here?
I think, I watch with some interest when your commodities person comes and talks about percentage longs versus shorts, etc. My personal feeling is I think the most over-participated space right now, where the feeling of left out, typically is metals. So the way the things happen is the first few moves are all dramatic moves, and then for the last few months it's been sort of roiling around in a particular small range, and participation has been building up. So I tend to believe that the metals are actually ready for a shake-off. Okay. And I think China has been, pardon the use of the word, but probably manipulating the metals thing with a view to sort of bolstering their own economy. And I personally believe that some of the metals prices have been ramped up, with massive participation. These are crowded spaces, and I think metals will come off. This is what my personal feeling.
So now one has to ask you the other space whose fortunes hinge on steel prices, actually, public sector banks. Always screaming value, but will you dip in?
See, I think, given the fact that we are involved in a number of restructuring cases, I can definitely say one thing, that a lot of provisioning has been taken. So one way of solving this problem is actually to keep providing. So what happens is every quarter, what banks have been doing is keep providing up to, say, 65, 70, 72%, by which time you've got a residual value which can be recovered, even if the account was completely gone, as it were. So from that perspective, I think provisioning levels are at a pretty healthy level for most people. At least for the big boys, it's certainly the case. Is there a turnaround in the fortunes? I think there's a bigger moral question that I have, which is that if the likes of JSW and Tata Steel are servicing their interest and debt and principal, and are doing so with scarcely a demand for any restructuring, then other people in the space who are asking for 50% almost as an entitlement, because the S4A seems to indicate that you could go up to 50% rather than saying you are now given a 50% write-off. If those spaces are taking a 50% write-off because they glossed over on the capex and are now going to supply in the markets the same products, I think it's a serious problem for compliance. You're almost saying that the good boys will get punished because they didn't ask for restructuring. Tata Steel could have asked for restructuring despite all the, pressures that it had with Chorus. It did not. JSW has an increased capacity and has done an admirable job servicing its interest and principal, and hasn't asked for any restructuring. And you think anybody would have said no to a restructuring of 525 without any? But they've not asked for any restructuring. So why penalize them? That's one. So on the other hand, I think these metals, etc., while you look at steel prices going up, I think the costs have also been going up. So I think we need to take this with
absolutely.
The net margins for converters is still very, very abysmally small. And I think converters will disappear. It's only the integrated players who will survive. So from that perspective, I think some of the big players will survive, but this bigger question sort of begs answering, how do you do this? And till today, time for introspection, not one single restructuring, call it S4A, call it SDR, has actually seen the light of day. So where is it that we're going wrong? And I personally believe the way we're going wrong is we're not looking at a restructured thing from a cash flow perspective as to what debt it can support. And hopefully the new NCLT will move people into bankruptcy, and therefore that spurring restructuring rather than this normative sort of things of RBI.
Well, one calculation is that a further 86,000 crores of provisioning is needed only for the 9.5% of GNPs already classified.
Okay.
So, I mean, 86,000 crores over the next 4 quarters is not a very small sum of money. So,
is.
short point, you will not touch PSU bank. You will not touch corporate lenders.
So, I will not for another reason, which is that I don't see them closing out this loop and growing with capital being adequate. That's the problem. So, ultimately, you're buying growth. You can buy a resolution of problems up to a point, but if there's no ability to grow, and I think that is linked to the IDBI, KFA issue, that the terror that which has struck that space is
paralyzing.
Is palpable. I mean, you can actually see nobody wants, and why should they take decisions when you're not sure that 15 years later, somebody will come up to, sort of.
I know, come and haul you up for investigation. Sure. Fair point.
Jakes,
okay.
Leave us with one more prediction then. 9100 gets taken out. Do you think the market makes a much bigger high this year?
I think on the sort of near term, one will always get it wrong. So I don't want even to go down that path. All I'm trying to say is, I think, as we see, given the what we put out, I think 85, 8600 seems like a very good durable bottom. And when that is the case, typically you take a 10, 12% higher than that as the new range. So if 85, 96 was a new range, would it surprise me? It wouldn't. Could market scale higher levels? Yes. But remember one thing, it's a mountain climb, right? So at every stage, the markets need to pause and move on. I mean, that's truism. But
and who would be leading that climb?
Well, I mean, we're sitting in a studio which is probably owned by, the larger.
You are not bound by anything.
I'm not bound by. No,
Jakes,
but
we have to give disclosures.
So I'm giving the disclosure, saying that it's probably, maybe after many, in an abstinence-based year of investment, Reliance may well turn out to be, that shining light in the markets. That's why, and that's. I don't, as I said, this is not about Reliance, but I think broadly I feel it. So it's not a disclosure about a stock that I like or don't like. I just think Reliance could lead the way.
All right, Jakes.